Common exit route including initial public offering, because the company, whenever they are going to issue a share for the first time, which is always call it as a initial public offering, which is coming under the primary market. When we get to know the factors or key element, easily we can tackle from the beginning or early stage. Improving cash flow. Here majorly we can find out the cash flow in the two nature. One is inflow and outflow. Hello everyone, a warm welcome to one and all. I am Natesh, lecturer in commerce, Vidhyaashram First Grade College, MYSURU, the Temple of Excellence. We are in the 5th semester BCom Financial Institutions and Market. The chapter name is Non-Banking Finance Company and Forex Marketing. And today my agenda, you are getting a more clarity about the mutual fund meaning and functions, major functions, and the meaning and functions of venture capital fund, and the meaning and definition functions of factors. Okay, and the meaning and functions of forfeiting, the meaning and functions of credit rating, the meaning and functions of depository and custodian service, meaning and concept of Forex market, and the importance of Forex market, merits of Forex market, and what are the causes and effect of influence, fluctuation in the foreign exchange market. What are the major causes? Next, moving to the first one, mutual fund, which is a mutual fund, which is the latest financial product. Every company, so every investors are going for investing in the mutual fund. A mutual fund is a financial vehicle that pool money from the multiple investor, not only for the individuals, even the businessmen are going for investing. To invest in the diversified portfolio of stock. Instead of investing particular company, if you try to go for investing in the mutual fund, so mutual fund sponsor, they try to go for diversification of investment in the stock, bond and other security. Investor in the mutual fund buy shares and fund net assets value, NAV, represent the value of one share in the fund. We can find out the liquidity positions. The net assets value is calculated daily basis on the fund underlying asset, because they are investing for the net assets value. Moving for functions of mutual fund, the major functions, the mutual fund sponsor, they are trying to go for diversified. That means they are investing in the different project, the different company. Mutual fund provide investors with a diversified investment portfolio so that we can reduce the risk factor, spreading risk across the various assets. They are investing for the specific asset. Now next one, professional management. Because if we are dealing the mutual fund, professional fund manager is very, very important role is taking. So fund manager with the expertise, financial marketing activity, managing the mutual fund, how they want to go for analyzing, go for research, evaluating or performance checking. Next one, liquidity. Obviously this particular financial instrument like a mutual fund which is having a complete liquidity, this provide liquidity allowing investor to access their money relatively easily compared to some other form of investment, because everybody are nowadays approaching with the liquidity asset, because easily they can convert. Next, convenience. Mutual fund offer a convenient way to investor to participate in the financial market, because we have a complete freedom to choose any specific instrument, financial product for investing without directly managing a individual security. We cannot, in other security, in case of any particular company we invested, we need to observe always the share price of face value or market value. But in case of mutual fund, which is giving a complete convenience. Next one, economic of scale. When we are talking related to economical, always we are comparing the progress. So here by pooling the fund from the numerous investor using a mutual fund, definitely this fund what we are generating with the help of mutual fund, which is going for multiple project. So investing for the industry or expansion or merger. Mutual fund benefit from the economic scale because we can find out the progress. Now, regulatory oversight, which is regulated directly from the SEBI. Regulation often require transparency in the report. Okay, every periodical they are preparing a reporting how the policy are set for, or rules and regulations set for mutual fund. So obviously they want to go under the guidelines of regulatory authority, providing investors with the accurate and timely information about the fund performance and holding. Okay, either they can go for selling after 1 month or 1 year. So obviously they want information about it. Next one, under venture capital fund, which is very important for new startup funding. Okay, a new project. The venture capital fund, a pool capital rise from the various investors, okay, such as institution, such as high net worth individual from, you can pull from the high net worth and institutional investor. Most of the company are institutional financial institutions, or they try to go for investing or rising, or corporation. With the primary purpose of investing is a startup. The main focus is a startup and early stage company. Okay, next, moving forward, the venture capital fund main function. The first one, capital injection. The capital injection, which is talking related to the new startup and early startup, and venture capital fund provide finance capital to startup and early stage company. Okay, because they are going to start here. In exchange for an ownership stake, this capital used to product development and market expansion. This particular capital are using for market expansion or project expansion. So the strategic guidance, very important guidelines we are following here. In addition to funding, venture capitalists often offer strategic guidelines, because everywhere the strategic role is very important. So the business expertise is portfolio company. They can analyze, they can take the strategic decisions, strategic planning is done here. Now, risk mitigation. When you are investing in the mutual capital, the risk is almost reduced. The venture capital, they diversify their portfolio to spread risk across the multiple company, because they whatever they're getting a finance, so which is going for investing in the other company. Okay, so one company, if it is facing any loss, they can try to balance with other company if they're getting a profit, knowing that some investment may fail and other will succeed. Okay, so we have to think always what and all the risk is connected for any instrument. Moving for exit strategy, venture capital fund work forward realizing return on their investment through various exit strategy. That means easily they can go out of this. Common exit route including initial public offering, because the company, whenever they are going to issue a share for the first time, which is always call it as a initial public offering, which is coming under the primary market, and IPO, so merger and acquisition case, and secondary market sales easily. Next one, value addition. What addition value we are finding here? Behind financial support, venture capitalist, okay, those who are investing under the venture capital, either your institution, okay, add value by leveraging their industry knowledge, network and experience to help portfolio company, because they already expertise in the field of venture capital concept. So they can take a proper decision which company is booming like this. There are challenges and scale their operation and become a successful in the marketplace. So that because of expertise in that area, they are able to go for predicting the market. So moving forward, next one, the meaning of factors. Factors, what exactly? In the general sense, factors refers to the element or condition that contribute to particular outcomes. Okay, what particular outcomes or result in various contexts such as business, when we are talking related. So which is a finance or decisions making factor can be the variable for influencing the situation. There are in a business, there are different situations they are facing, or different decisions are taking, either strategic decision or routine decision, finance related decisions, obviously. Next one, the functions of factors. The first one, identification of influence. What exactly will influence? What factors are influencing? Okay, so one of the primary functions of the considering factor is to identify the key elements that can impact the process. Okay, so you need to find out the crux of the point, the exactly problem where which elements which is starting from there, and decisions and outcome. This help in understanding the complexity of the situation, because when we are get to know the factors or key element, easily we can tackle from the beginning or early stage. So next one, risk assessment. Easily we can assess the risk. Factors are often accessed to evaluate the potential risk. By identifying and analyzing factor individually, or organization can better anticipate challenge and make informed decisions to mitigate risk. So what and all which is related to the business approach, when we are predicting for advanced risk, there are majorly the risk is related to competition, financial risk, systematic risk, unsystematic risk. So using different tools, they try to go for analyzing and evaluating. Next one, strategic plan. How strategic decisions are important. The same thing, the strategic planning is very important, which is set by the strategic management. So when making strategic decision, considering various factors, okay, blindly they cannot take any planning or decision. So they need to identify the what are the factors are influencing. Okay, become a crucial. This include market condition. They need to identify the market condition, market trend. Okay, the various economical trend, what exactly the competition, okay, and the internal strength and weakness, what opportunity they are getting there, that's what they are trying to go for, doing analysis like a SWOT analysis. Okay, next one, problem solving. This specific factors will go always solving the problem because of planning, because of decision. In problem solving scenario, identify the relevant factor, help in isolate the root cause of issue. Once you identify what factors are influencing for your decisions or problem. Okay, so this facilitate targeted solution rather than the addressing symptoms. So obviously we need to identify from the basic, we need to identify what factors are influencing, what symptom we are getting. Moving to the next one, meaning of forfeiting. Meaning of forfeiting, which is nothing a reissue here. Meaning of forfeiting. Forfeiting is a financial term, is a method of trade finance where the exporter, that means seller, surrender the right to receive payment for the goods sold to third party, known as forfeiter. Okay, here forfeiter and forfeiting. This is usually done at the discount price. Suppose the face value is 100. If you try to go surrender, if you're getting a 90 rupees or 80 rupees, something discounting is happening. And the forfeiter assume that the risk of non-payment by the buyer. Okay, so either fully paid or partly paid, we need to identify. Okay, moving forward, functions of the forfeiting. First one, risk mitigation. Everywhere the same point are repeating functions. Here the risk you have to reduce. Forfeiting help to exporter to mitigate the risk of the non-payment of transferring it to forfeited institution. Any particular financial institution, they are doing a forfeiting, which is always approaching the non-payment with the help of buyers. This is a particular useful for international trade where the party may be unfamiliar with each other and credit risk are higher. Next one, improving cash flow. Here majorly we can find out the cash flow in the two nature. One is inflow and outflow. Outflow is going out, inflow is coming inside. Exporter can receive immediate cash from the goods by using forfeiting. Okay, exporter, that means forfeiter. Even if the payment from the buyer is deferred because the delay in the payments. This can improve the exporter cash flow and provide fund for other business activity. Because of due dates, because of delay in the payment, so the working capital also affecting. So next one, enhancing competitiveness. Okay, we need to go for always competing. We are not coming under the monopoly, in the sense we are facing the competition. So offering favorable payment terms to buy can make a business more competitive. Next one, the forfeiting allow exporter to offer attractive credit term to buyer without assuming the associated credit risk. So if you are rising or giving lending money or borrowing money, obviously there is risk is connected. Okay, we need to go for approaching using a forfeiting. Next, facilitating international trade, which is always facilitating while they are doing a international trade. Forfeiting facilitate cross-border trade by the providing financial mechanism that address the challenge of credit risk and payment delay associated with the international transaction. Either you are importing or doing exporting. Okay, so obviously the credit transaction is a role, major role. So the which is when you are rising up, depending on the credit transaction, you are committing for the risk. Next one, credit rating meaning. So what exactly credit rating meaning? So when credit, which is a lending money, okay, so here the credit rating refers to the assessment of credit worthiness of an entity, which whatever the credit which is related, so such as a corporation, government or financial instrument. Okay, so using something different instrument we are using. It involves evaluating the ability to entity to meet the financial obligation. To meet the obligation, every business having an obligation. Okay, so the particularly the repayment of debts. Okay, when you are taking long term loan or medium term loan, you have a responsibility to repay. Okay, so the credit rating agency, there is a major credit agency. There are different roles are taking rating based on the various finance and non-financial factor. Moving forward, the functions of credit rate, the majorly we can find out the major function. One is the risk assessment. Credit rating agency evaluate the risk associated with the lending money, because when you are lending money, obviously we can find out the credit. So when you are depending on the credit, when you are expecting a credit, obviously there is something like a rate. Particular entity, the analyze financial statement, they want to analyze what is the balance sheet or using something technique or comparative statement. Okay, the cash flow, debt level and other relevant factors to determine the likelihood of the default. We need to, once you are preparing the statement cash flow, okay, so then we will get to know. Next one, investor guidance. So those who are going for investing, okay, so obviously the credit rating serve as a guide for investor to access the risk return profile of a particular instrument. Now every instrument having investment instrument having a risk. Okay, so they want to give a guidelines for them, because you need to educate them. Higher rated instrument are generally considered lower risk, because higher rated instrument is having a lower risk, but may offer low return because the return is very less. While lower rate instrument, when you are trying to go for 100 rupees face value, so which is compared to 1000 rupees face value, the return is very less only. Okay, so may carry higher risk and potential return, so they can expect maximum return because they are invested for 100, okay, 1000 rupees. Now meaning of depository and custodian service. So the depository, we are approaching with the depository as well as custodian service we are finding. So this involve the safekeeping, okay, because your money is safely want to deposit. Okay, now for example, there is electronic platform. While you are going for investing, we are directly the investment primary market or secondary market, which is completely controlled national stock exchange. The depository also we are finding here. And administration of securities such as stock, bond in a electronic form, because the data is already stored. We are doing a transaction between the with the help of electronic platform. So depository institutions like a central depository, when you are talking related to national stock exchange, which is coming under central, facilitate the trading and settlement of a security in the materialized or electronic format, because anybody are willing to go for investing in this stock market or security market, definitely they should open an account like with the help of investment bank. They want to open a demat account, which is completely depending on the electronic platform. Now the custodian service. So whatever they're accepting, whatever they're receiving a money from the investor, so which is almost they want to safety, the custodian service involve the safekeeping the financial asset what, okay, and other related service. Custodian often bank or specialized financial institution hold and safeguard clients. The client what they are paying money or buying the security, so definitely the custodian role or service is very essential. Security and may provide service such as trade settlement. If the customer, the investor or shareholders are selling at the time, the working hours, working days, T2, trading to or settlement will be happening. So this is also taken care by the custodian service. And the collection and report. Whenever the investors want to get what transaction I did, with the help of report, they can get to know what profit, what loss, okay, what is the charges. Now, the functions of a depository service, the major function, one is the safekeeping security, obviously, and the dematerialized format, which is an electronic format, and electronic settlement. Everything is electronic payment. With the help of electronic payment, with the help of electronic only settlement is happening. And the book entry system, each and every transaction is only properly recorded in the electronic platform, the database already stored. Now the corporate action, which is always going, approaching any company or listing under Bombay Stock Exchange and National Stock Exchange, which is going for the corporate approach or action. Intermediary between the investors and issuers. Moving to the functions of custodian service, again same thing, safekeeping of asset, settlement service, income collection, okay. Now the corporate governance service, we are doing corporate service, okay, and reporting and record keeping is very important. Foreign asset custody, because foreign company can also expecting here. Next one, the meaning of Forex market. The meaning of Forex market, which is related to foreign exchange. Okay. So, now because of liberalization or globalization or privatization, any country have a freedom to go for investing anywhere. Okay. So, the foreign market, also known as a foreign exchange market, it is a global marketplace for trading of currency, which is only focusing on the currency. Okay. So when you are doing for international trade, import or export, definitely we need to approach the Forex market. It is the largest and most liquid finance market in the world. We are talking Forex means foreign. Okay. So where participants exchange one currency for another at agreed upon the exchange rate. The exchange rate, which is not always constant, which is always fluctuation. What is the reason and effect? We can you can get more clarity in the coming slides. The Forex market operate 24 hours, which is 24 hours, 5 days a week. Play a pivotal role in the global economy. This is very important. Next one, the concept of Forex market, where exactly? The Forex market, short for the foreign exchange market, in global decentralized, which is a completely country to country, which is a decentralized, and over the counter, which is always going for over the counter. Okay. Market plus, where participant trade currency. Okay, the currency will be movement. In simpler term, it is the market where one country currency is exchanged for another at the agreed upon exchange rate. What agreed currency? The dollar rate and pound rate, okay, euro rate will keep on change. Okay. So the Forex market operate again 24 hours, 5 days a week, due to global nature of currency trading, because we are not only one country is doing, almost all the country are doing a Forex market. Now, what are the importance of Forex market? Here, the facilitation for international trade, which is always facilitating, because we are approaching for, we are dealing a trade in between other country. So, the Forex enable to exchange of currency. Once you are sold or exporting for other country, we need to get exchange from according to our country currency, allowing business to engage international trade by converting one currency to another. Next one, price discovery. We can find out what exactly the currency rate or increase or decrease. Exchange rate determined in the foreign market reflect the relative value of different currency, providing a basis for pricing goods and service globally. So when you're selling in the last month the currency rate, and when you are trying to do for trading in the next coming month, okay, the currency rate cannot be constant. That's why the price is always you have to decide. Hedging and risk management. Business and investor use the forex market to hedge against the currency risk. Okay, obviously there is a currency exchange suddenly, if it is fall down, okay, or increase or decrease, okay, some variations we are finding. So reducing the impact of currency fluctuation on their operation and investment. Now moving to the next one, there is speculation and investment. There is no constant price. That's what we can say. It is the speculations are going. Yeah. So the trader engage in the forex market for speculative purpose, okay, aiming to profit the fluctuation in the currency price. So which is always focusing or aiming for the fluctuation of price currency. Additionally, it serves as an investment opportunity for the looking to diversify their portfolio, so that the individual country can decide or individual company can decide what exactly. Next, merits of forex market. There are too many merits which is related to forex market. So one is high liquidity. So the forex market is most liquid finance market. When you compare to nation, we are trying to compare with the globally, which is always liquidity. Okay, facilitate easy and quick transaction, which in a fraction of second we can do with the transaction, currency transaction. Traders can buy or sell currency with the minimum price impact, which is also latest instrument we are finding. So here the 24 hours accessibility, only weekly 5 days. Okay, so forex operate 24 hours a day, 5 days in a week, allowing participant to engage the trading at any time, irrespective of their location. Based on the location, based on the geographical location, they are doing a transaction. And global presence, which is not only focusing for the individual country, which is we are doing international trade, means which is always presence for the global. So as a decentralized market, the forex market span the entire globe, which is covered for the entire globe. This globe presence provide the traders with a vast era of currency pairs to trade, offering diverse for opportunity. We can find out the opportunity here. And the low transaction cost compared to other instruments, the transaction cost is very low. The transaction cost in the forex market are relatively low compared to other financial market. So the transaction card, which is an approaching or opening an account like this, this is due to the absence of intermediator. Here we are not finding any intermediator. The broker exchange we are not finding. Leverage opportunity. So the forex trading allow for high leverage, enable traders to control a large position with the relative small amount of capital. So using small amount, they can go for investing, holding a security, or they can have a position. So next one, what are the causes for fluctuations in the foreign exchange rate? Because whenever the country, when you are doing for international trade, the currency are exchanging due to number of causes. Okay, the first one, economical indicators. So the major parameters or index are considered. One is interest rate. One is interest rate. So change in the interest rate affect the currency value. This is one which is directly interest rate, which is connected to the economical factors. So higher interest rate attract foreign capital, leading to the currency appreciation. Higher interest, which is appreciation, the currency rate will increase. Next one, inflation rate. The currency value, if it is increased, okay, so if there is something like inflations we are finding, which is also connected to the economical factors. So lower inflation rate, enhance currency value as a purchasing of a low power of increase. Yeah. Next one, second one, the market sentiment, which is directly connected to the market. The first one, the speculation. How speculated for the individual currency country. So the trader perception of future economical condition can lead to speculative trading. okay, and impacting the changes exchange rate. Easily they can predict using something strategy or tool. Now next one, political stability. There are something like a political interference will happening here. So the political event or uncertainty can influence investor to confidence and currency value. These are the major. Next, moving to the trade balance. If you are not balancing your trade like with the help of demand or supply or dealing with the other country. So the first one, current account deficit and surpluses. In case the deficit or surplus, so the country with the trade deficit may experience currency depreciation. Because of deficit, the currency will be depreciated. In case of surplus, while surplus means the currency lead to appreciation, the currency rate will increase. So next one, government intervention. Here the central bank action. In India, central bank is an RBI. When central bank, when it is intervention by the central bank buy or sells currency can influence the exchange rate. Okay. Next one, the foreign exchange reserve. What exactly any country want to reserve, okay, based on the currency. The amount of foreign currency held by the country central bank can impact on the currency value. What percentage they held, okay, central bank is held. So moving to the effect of fluctuation in the foreign exchange rate. The first one, trade balance. Under trade balance, we can find out export competitiveness. Either export is increasing or import is increasing or decreasing. Here, the currency depreciation can make export cheaper, boosting the country competitiveness. If export is increased, in case import cost, while you are importing any weaker currency may increase the cost of import, potential leading to the trade imbalance. We are not balancing the trade. So, okay. Next one, inflation and interest rate. Okay, that is also major factor. Importer influence. Currency depreciation can be contribute to importer influence through the higher import cost are incurred. Next one, interest rate impact. Change in any particular exchange rate may be influence central bank decisions on the interest rate to control inflation. Okay, easily they want to go for monitoring. And moving to the investment flow. What investment flow we are finding? The one is for foreign direct investment, FDI. Exchange rate stability, okay, attract FDI, while volatile may deter investor. Next one, portfolio investment. We have how it is diversified into the portfolio. So investor may move fund between the currency based on the exchange rate expectation. Okay. Next one, economical growth. In fact, on GDP, fluctuations can affect the country economical growth by influencing trade, okay, and investment and inflation. So this is also major contribution we are finding. And next one, global economical condition. What exactly the global economical condition? Exchange rate movement can be reflect in fact a broader global economic trend. Thank you.